Okay, can you guys hear me? Yes, no, just a thumbs up. Someone can just say yes or type in the chat yes. If you want to get started.
I can hear you.
Okay.
I can hear you.
Okay, so welcome to today's class, guys. So this is day one of the Deferred Tax Free Masterclass. I am Faiz Khan. I run EduHans. EduHans provides online courses to help aspiring chartered accountants like you, CTA and third year students to pass their exams confidently. So our main purpose over here is to be a place of hope, a place of optimism. And we do that by making difficult concepts, simplifying difficult concepts, and providing you with a thought process, a way of thinking, so you can handle any possible question. So that's basically be about EduHans, about myself. Over the course of the year, we will be doing free classes. We will soon start running every Saturday. We will do a class for an hour from 11 till 12, not every Saturday, but most Saturdays. When I say every Saturday, I'm referring to during class time. Okay, so whenever there is UNISA classes and there's time and we're preparing for a test, so those Saturdays we'll be we'll be having classes. But I'll share the details with you in the coming days. Okay, so so today what we're going to do, we're going to do deferred tax. So we're going to be covering over 2 days. The structure is going to be as follows. Day one, which is today, we're going to go into understanding the theory of deferred tax. Then tomorrow, we're going to put that theory into practice by covering a question. The question will be a CTA test one question on deferred tax. So we'll cover that tomorrow. Okay, so today is going through the theory. The theory is going to be quite technical because we're gonna make use of IAS 12, the accounting standards. So I want to go through the accounting standard with you. I mean, not physically, but I'll take you through it and explain the important concepts of IAS 12. Take note, IAS 12 deals with two parts. IAS 12, it deals with income taxes, and income taxes has two parts. It has current tax and it has deferred tax. I won't be dealing with the current tax aspect. I'll be dealing with the deferred tax aspect. So IAS 12 is quite lengthy and most of it relates to deferred tax. So we will only be covering the important concepts of deferred tax. And I'm going to bring you the technical definitions and the technical theory, and then we're going to simplify it using basic examples. And then tomorrow in day two, we will do a test level question. The test level question, like I said, is a CTA question, but a third year student should also be able to handle it. So for third year students, it's also applicable to you. Okay. So what we're going to be covering today, I'm going to switch over into Excel, and then we're going to work through Excel. But basically, what we're going to be covering when it comes to deferred tax, I'm basically going to go through a big picture understanding of deferred tax. Then I'll discuss very quickly the objective of deferred tax. When it comes to accounting, there is definitely or highly likely there is going to be an accounting standard for whatever you're dealing with. And in each accounting standard, they start off with the objective of the accounting standard. So if you understand what the standard is trying to achieve, then when you study the standard, it will make a lot more sense. Okay, so just take note of that. Then we will go through some of the important definitions. I'm not going to go through all the definitions because there's a lot. Okay, so you will have to read through the standard itself, but I'll touch on the important definitions. Particularly, I'm going to touch on the definitions of a taxable temporary difference as well as a deductible temporary difference. I'm also going to touch on the definition of a tax basis, a tax base for an asset and a tax base for a liability. Knowing those four definitions is going to be critical to applying deferred tax to any given question. So when we're going to determine What is the tax base? We're not going to use it based on what we did in a previous question. We're going to cover it based on applying the definition within IAS 12. Similarly, with determining whether a temporary difference is a taxable temporary difference or whether a temporary difference is a deductible temporary difference, we're going to apply the definition within IAS 12 to figure it out. And we're not going to do it through memory or memorization or anything of that nature. So that by applying the standard itself, you will be able to handle any given question that comes your way. Even if you haven't seen it before, you'll be able to sit back and use the definition to figure out what you need to do. So we will spend some time on that. Then we will discuss the recognition of a deferred tax asset and a deferred tax liability. We will also go through the recognition of deferred tax. So remember, there's two parts when it comes to deferred tax. There's deferred tax, the asset or liability, and then there's the deferred, so that is the statement of financial position aspect, and then there's deferred tax, profit or loss, other comprehensive income, or directly or equity, that's the other side. So when we talk about deferred tax asset and deferred tax liability, there are separate recognition criteria over there. And then when we talk about deferred tax, just deferred tax, then we're referring to either profit or loss or other comprehensive income or directly through equity. And I'll touch on that. So there are two types of recognitions we're going to deal with. Recognition relating to deferred tax assets and liabilities, and a recognition relating to deferred tax, which implies the income statement aspect. Okay, then we will end off with going through the measurement of deferred tax. So as we do it, we're gonna do two things. We're gonna do three things. Cover the technical definition. Then we're gonna apply the technical definition to a basic example. And then number three, through applying the technical definition to a basic, really very, very basic example, we'll teach you an approach to think about deferred tax. Okay, and we will further solidify the thinking approach tomorrow in day 2. So for now, we're going to do the real basics, but these basics is going to be the foundation for the rest of the course. If you got my emails, you would have seen I called it the Beetroot of Accounting, right? So the question is, why is it called the Beetroot? I didn't make it up, okay? I heard of it sometime when I was a student or whenever I heard about it. So where did I hear about the Beetroot of Accounting? Is if you just picture putting beetroot into your plate when you eat food, basically your whole plate becomes purple, your food becomes purple, your fingers, everything becomes purple, right? Now that is deferred tax. Deferred tax basically has implications on almost every possible transaction that goes through accounting. So whenever you process journal entries, once you are done with the journal entries and you are happy that the journal entries are correct, what is the first question you need to ask after that point? The first question should be, is there any deferred tax consequences? That should be the question you need to ask yourself. So whenever you process journal entries or you think through journal entries, you need to ask yourself the question, is there deferred tax consequences? Because deferred tax basically touches everything. Okay, so take note, that is why it's called the Beetroot of Accounting. So that's it for now. I'm going to switch over into Excel, and then we're going to go through a big picture view regarding deferred tax, so you can understand why do we have deferred tax in the very first place. Okay, so while I switch over, if you have any questions, you can let me know, but I'm going to switch over now into Excel or whatever, Google Sheets. I'm going to take off my camera now, okay? Yes, it is recorded. Okay, so you should be able to see Google Sheets in front of you. I'm just gonna close off all of these stuff. You just please stop the screen. I just want to close off everything first. Okay, so you should be able to see Google Sheets in front of you. So now we're going to do a high-level overview really quickly to understand what is the purpose of deferred tax? Why do we even have deferred tax in the first place? Now, what you should know, deferred tax is a balance sheet, is a statement of financial position, item, but I'm going to explain it from an income statement point of view. Okay. So typically, you would have a profit or loss statement. Okay, so we would have a profit or loss statement. I'm not using the proper terms. You know, it's statement of company, whatever it's called, statement of profit, loss, and other comprehensive income. Okay, so we have a statement, a profit or loss statement. Okay, a profit or loss statement basically would look as follows: sales less less cost of sales equals gross profit. Okay, so that would equal gross profit. Then we would add other expenses, other income. We would subtract other expenses, and then this would give us can someone else here? Can everybody else here? Someone can't hear, but can anyone? So everyone, guys, everyone can hear. Just maybe check your Microsoft or just restart and then join back in. Okay, and then we have what am I doing? And then this will give us profit before tax. Then we have income taxes, and then this would be profit after tax. Okay, then we end up with profit after tax. Now, this is important to understand. When we have sales, okay, the sales number, the accounting standard that applies to sales is IFRS 15, revenue. Okay, so IFRS 15 applies to sales, which is revenue. So therefore, sales is determined using accounting principles. Okay, so sales is determined using accounting principles. Then we have cost of sales. Okay, so cost of sales is basically inventory that is being sold. Okay, so cost of sales comes about as a result of inventory being sold or inventory being written off or something of that nature. So cost of sales is basically determined using IAS2 inventories. Okay, so IAS2 is the standard for inventory. So once again, cost of sales is calculated or determined using accounting. What is this? Just give me what is happening here? Quickly, just give me 2 minutes. Something wrong with my Zoom. I'm just gonna pause this quickly. Resume. Okay. Just give me 2 more minutes. I just want to sort out something wrong with my Zoom. I'll be back now. Okay, guys, let's hope it's working now. I just ran into some problems here, but let's just hope it's working. So let me just continue where I left off. So we have sales. So sales is determined using the revenue standard. So that is determined using accounting principles. Cost of sales is determined using IAS2 inventory standard. So that is determined using accounting principles. Now, gross profit is sales minus cost of sales. So by default, this is basically determined using accounting principles. Then you have other income. Other income is whatever interest income, rent income, whatever. These other income comes through different standards, IFRS 9, IFRS 13, different standards, okay? So as a result, it's based on accounting standards. So no. Are you guys here? Can you hear me? Did you guys just disappeared for a moment? Just tell me.
We can hear you, Faiz.
Okay, so that is used based on using different accounting standards. Okay. Similarly, we have other expenses. Other expenses also comes through different types of stuff. For example, lease expenses, which is IFRS 16, depreciation, which is IAS 16, amortization, which is IAS 40, IAS 38. Then we have fair value gains or losses, which is IAS 40. Then we have stuff relating to IFRS 9. So other expenses is made up of a whole host of accounting standards. As a result, other expenses is also determined using accounting principles. Now, profit before tax. Profit before tax is made up of sales minus cost of sales plus other income minus other expenses. All of those are based on accounting principles. So as a result, profit before tax is also determined using accounting principles. Now we come to income taxes. If we ignore deferred tax for now, okay, so let's just ignore deferred tax for now. Income taxes is basically the tax that we have to pay to the, it's basically the tax we have to pay to the tax authorities. So for our purposes, the tax authorities is SARS. The way SARS assess how much we must pay them is using the Income Tax Act, okay? So that is using the Income Tax Act. So by using the Income Tax Act, you see that the profit after tax line item is now based on accounting and tax. Now, we don't want that. So from an accounting perspective, we ideally want profit after tax to be completely an accounting number. So the way to get that, the way to get profit after tax to be completely an accounting number is to make sure that income taxes is an accounting number. Now, we are unable to change how